Okay, for our next topic, we're going to shift from investing to trading and see what will ChatGPT tell us about trading. So let's see what is stock trading? And I'll give you my definition afterwards. Stock trading is the buying and selling of stocks or shares or in publicly traded companies. It is a way for individuals to invest in the stock market and potentially make a profit trying buying low and selling high, or by collecting dividends from ownership. Stock tracking can be done throughout a brokerage account with a registered broker. Okay, so very vanilla answer here. How I differentiate what is trading and what is investing. So trading is the short-term way of buying and selling stocks. You get in, you get out, either you take your profit, you take your loss, whatever it is, that was a trade. You were planning to trade it on some news or at some event or for a day, or for a couple of weeks or a month or something happening, right? So whatever your trading strategy, and we're going to ask it about some trading strategies here, we'll see what it has, but whatever you were thinking or whatever your strategy is, it was get in, get out. Whereas investing is the long-term view where we buy a stock and we hold it for the longer term, whether it is through for years or decades or whatever it is. We wait for the capital appreciation or for getting dividends throughout the time period that we're holding the stock, but that's what the main difference is. And the best part, like a combination of the two, is what I highly recommend, is actively investing. So yes, investing for the long term, but having an actively managed portfolio where you do constant changes, you track the market, you follow what's happening, and then you do slight adjustments to your investments. I'm not of the belief that you just buy into an index or you just set it and forget it, kind of, because there's many things that are happening, especially in the last couple of years, where if you do some financial education, if you follow the markets, you can really take buy stocks at a much better price tag than what the index would be buying. Like if you were buying the S&P 500 throughout 2022, you would be buying Tesla in the 300s, right, in the 200s. Whereas if you were waiting for that momentum trade downwards to finish, you could have gotten it at a far cheaper price. So there is instances of where actively managing your portfolio really helps, but after actively managing for the long term, that is active investing. Whereas trading, get in, get out, take your profit or your loss, and that's pretty much it. So let's see what are some trading strategies. Here are some common stock trading strategies. Buy and hold. Okay, we thought about that, and pretty much buy and hold is what I pretty much said is investing. So you buy it and you hold it. That's here a strategy. Okay, value investing. Again, the strategy includes, we already talked about this, getting stocks that are undervalued by the market. Growth investing. So it's really kind of giving us the investing momentum trading, but really it also told us about momentum investing. So that's pretty much everything here. The only thing that I would consider trading is momentum trading. I gave this example in the investing video where I talked about how with stocks like the meme stocks or like Tesla or like Facebook, Meta, sorry, the new name, but you can you can trade the momentum going upwards or lowers. Index investing, no, day trading. So there it is, pretty much the only thing here, day trading. Okay, the strategy involves buying and selling stocks while within the same day, taking advantage of the short-term rate. Okay, let's be more specific here. Okay, what are some, not day, we're gonna ask it for a day, but short-term trading strategies. And let's see if it tells us some trading strategies like that. Scalping. Okay, this is what we're looking for. So these are trading strategies here. So scalping. Okay, let's make it, leave it. Okay, boom. Stop right there. Okay. The strategy involves making many trades in a single day, taking advantage of small price movements. This is pretty much what algorithms do. So buy it at 55, 25 cents, sell it at 55, 28 cents, 30 cents, 35 cents. So very small, minute changes, get in, get out, take advantage of when a stock is going higher or lower. This is pretty, that's how algorithms work. It's not really useful for humans. You can do that, uh, but not really something that we can profitably do, let's say, for as humans. Swing trading. This strategy involves holding stocks for a few days. Okay, this is pretty much trading right here. Good. To a few weeks, taking advantage of a short term price trend. That's pretty much my definition of trading. So, couple of days, couple of weeks, maybe a month, get in, get out, and take advantage of some short term trends. Yes, that is so. Swing trading will be defined like that. Okay, day trading. The strategy involves buying and selling stocks within the same day, taking advantage of the short term price movements. Okay. Good, we can do that. Momentum trading, we already talked about that. Options trading, okay. We can do a separate topic on options, and because that's probably going to be a very long video. The strategy involves buying and selling option contracts so with the holder. It gives the holder the right but not the obligation to buy or sell a stock. So yes, we need to dive in deep for options, because there is first understanding what is an option, what is a put, what is a call, and then there is so many different strategies. So but right now, single stock investing, let's ask it this way: what are some day trading strategies? Okay, let's see if a single stock trading strategy can give us. Trend following. Perfect, perfect. Again, if you ask it the correct questions, it will give you the answers that you're looking for. So, trend following. The strategy involves identifying a stock current trend and buying it in the direction of the trend. In that trend, with the goal of selling for a profit later in the day. So if you don't know the saying, trend is your friend. Never go against the trend, because it's going to hurt you in the long run. And pretty much what we talked about, momentum, that is momentum trading or investing is based on the trend. So when patterns, whether traders, investors, algorithms, computers, whatever it is, realize that whether the market or a single stock is going in a particular way, they all jump in to get that trend. So they follow the trend either upwards or downwards. And we gave the example with Tesla, how it went from the 300s down to 100. And you could have gotten burned so many times throughout that downfall, just catching a falling knife. So that's what that's called. When you're trying, oh, I'm buying the dip, I'm buying the dip. No, you're going counter to the trend. But when the trend breaks, so Tesla pretty much kind of leveled off in the 100s, then you might not get it at the 103, which was the low. But then the trend breaks, it goes to 110, 120. Now the trend is upwards, and then you get it then, and you then take advantage of when the trend goes upwards, and now Tesla is in the 180s, 190s. So that's what following the trend is, and that's very advisable, unlike going against the trend. But everybody has their own preferences, but definitely follow trend is your friend has been a pretty good motto for anybody that has done trading. So keep that in mind. Scalping, we talked about that. That is something that algorithms can do. If you can program an algorithm today, it's very easy to program an algorithm in Python. For if you have one of those platforms, I believe the MetaTrader ones, you can make a bot that, or you can do it on your own, or you can ask somebody on Fiverr or wherever to make one for you. And then if you have a specific strategy, like buy stocks or sell stocks if this and this happens, It could be profitable. You can do even some back testing to see if that's the case, but the scalping is you can do scalping if you have an algorithmic program. But again, that is now accessible to the, let's say, mere mortal trader. Is not something that only the big companies have. So you could have an algorithm for let's say a couple $100, and whatever strategy you tell the programmer to put in, he's gonna put it in, whether it's gonna be profitable or not. Like, as the bot says here, past performance is not indicative of future performance, but you can track it and make modifications. Okay, breakout trading. This strategy involves identifying key price levels such as support and resistance, and making trends based on whether the stock price breaks through those levels. So this is more technical analysis. We're going to make a video of technical analysis, so I'm going to talk more about that there, because breakout points, resistance, supports, that's all technical analysis. So we're going to make a separate video on that. Momentum trading, again, it's really pushing for the momentum trading here, giving it all the time. And then mean reversion. This strategy involves buying stocks that have been underperforming with the expectation that they will eventually return to their average performance. And the classic example of this was Meta down in 2022. So it was just getting pummeled for no reason. Again, for the only reason was the trend. Everybody hated it. Everybody sold it. Everybody shorted it. Very similar with Tesla in the latter part of 2022. Everybody hated it, everybody sold it, everybody shorted it, and it just got pummeled. But as we are now witnessing in 2023, the stock will go back, revert to the mean. That doesn't mean it's going to revert to the highs, so neither Meta or Tesla are up in the 300s where they were a couple of years ago, for pretty much, yes, last year, but they will definitely revert to a mean, meaning a kind of more normal pace of either increasing prices or decreasing prices. And this is true if you're trading the market. So if there is nothing very stock specific. So again, Tesla was a good example because there was nothing stock specific about why the price was falling. Even with Meta, there was nothing stock specific. It was the market freaking out, whether it was about the Twitter purchase or whether it was about the investments in the metaverse. But both Facebook, or is the Meta is the company, but Facebook, Instagram, WhatsApp, the core business was doing fine. Very similar with Tesla. Tesla was doing fine. You can argue whether it is overvalued or undervalued, but the underlying business was not affected. So when you see discrepancies in prices like that, where the price of a stock is affected not by the individual performance of the company, but it is impacted due to some, let's say, outside factors that are negative for no really apparent reasons, and the company is still doing good, then the stock has a very high likelihood of reverting back to the mean. And if it was going higher, then a little bit come down, or if it was going very, very low, then come back again. So that is what reverting to the mean means. And it could take days, weeks, months, or in the case of Tesla, a couple of months. In the Tesla of Meta, like a little bit more than that. It's important to rate the trading can be high risk. Okay, let's finish on that note. That's very important. So it's important to note that day trading can be high risk and may result in significant losses. Very correct. So if you're planning on doing so, be aware that definitely, because when you invest, you hold it, and then through the downturn, if the stocks then or the market goes up, then at least you have a chance of getting your money back, even if you had some paper losses, right? But with trading, you buy, you sell, that's it. The moment you realize that loss, that's it. That's gone. There's no coming back. It's on to the next trade. It requires a strong understanding of market dynamics. It really does, and you need to do a lot of homework, and that's pretty much what we're doing here. Discipline, key. number one, like even more important than homework and knowledge is discipline. If you don't have the knowledge, if you don't have the discipline, it's just you might know the knowledge, you might know that, let's say, a stock is going to go higher, but you don't have the discipline to wait. You're experiencing a lot of losses, or you're like, I just messed up, I'm going to get out of the position earlier, or whatever it is. Or take profits. Even with profits, you get a little bit of a profit, but you don't wait for what you were thinking that's going to happen. So you had a set target, let's say, that this and this is going to happen, and the stock is going to go up by X amount, but you're like, I made a little bit of a profit. You don't have the discipline to wait for it, and then you take early. And that's pretty much the worst problem with discipline: taking profits early and holding losses for a very, very long time, because people have the mindset, hey, maybe it's going to come back, and then the loss grows and grows and grows, and you don't get out when you had your stop loss, but you just are holding, hoping that it's gonna get back. Whereas with the profits, again, you had a take profit range, but you're like, it's not going there, I'm gonna take it off. So getting smaller profits and then having bigger losses means that even if you have a profitable strategy of, let's say, 55-45, whereas 55 trades are profitable, 45 are unprofitable, but that means if the profits and the losses are the same, then you're gonna make money. But if your losses are way bigger than your profits, then even though there's 45 losses and only 55 profits, you're still going to lose money. So that's pretty much one of the key problems with trading: discipline, in the ability to quickly make informed decisions. Yes, that's true. You have to kind of make quick decisions when certain kind of economic data points are coming out, because let's say Apple on Friday, when it reported earnings, it opened at 147. Either you bought it or you sold it, whatever it was. 2 minutes later, it was at like 150 something. By like 5 minutes later, it was at 157. So pretty much $10 difference in a couple of minutes. So make that decision, because that was what, a 4% swing move in just a couple of minutes. So either you made it or you didn't. It's recommended to thoroughly understand the risks involved. Huge risks involved. Please know and understand those. Like, have that pretty much repeated to yourself every day, because there is huge risks involved. Consider your financial goals and risk tolerance. And also with the financial advisor, okay, obviously. But then, like, for young people, although the young people went in such a like different direction, where it was the YOLO trade, you only live once, and then they made super extremely risky trades. And I think that's why trading has gotten such a bad reputation. Trading is not as bad as it's made out to be, but it is highly risky. But if you are disciplined in your trading, then you can take advantage of it. But just doing risks like you only live once or whatever, just buying meme stocks or putting all bets on some super risky options, then at that point you're not trading, you're betting. So there's investing, there's trading, and they're just flat out betting. So you have to understand the main differences. Okay, let's get into the next topic.